Chapter 15 covers inventory costing. In the previous chapters, we learned the importance of merchandise inventory in calculating cost of goods sold and gross profit. Remember how to calculate cost of goods sold. We take our merchandise inventory at the beginning of the year, add all our purchases to get our goods available for sale. Then we go and count our inventory at the end of the year, subtract that from our goods available for sale, and we get our cost of goods sold. When this figure is subtracted from sales, we calculate our gross profit, and after we subtract our operating expenses, we come up with our net income. So the accuracy of the inventory accounts are very important if you want to get an accurate net income. Now, any errors in your inventory are going to cause errors on, of course, your income statement, as well as your statement of owner's equity and your balance sheet. So all your financial statements will be inaccurate for the current year and the following year, because ending inventory flows over as the beginning inventory for the next year. So that year will be incorrect as well. So it's very important that we use accurate inventory figures. Now, there are two ways that businesses account for inventory. There's the periodic method, which is what we learned in a previous chapter. When we make a purchase of inventory, we debit the purchases account and credit accounts payable. Then there's the perpetual method. In this method, the inventory account is debited for all merchandise purchases. The purchases account does not exist. So under the periodic method, we only know our true inventory one time, and that's at the end of the year once we count it, because anytime we make a purchase, it goes into the purchases account. With the perpetual method, theoretically, we should know our merchandise inventory balance at any time, because we're always keeping up with our merchandise inventory. So let's look at some examples. We've purchased $100 of merchandise inventory on account. So under the periodic system, we debit purchases and credit accounts payable. If we make a sale later of that inventory, we debit accounts receivable at the retail price and credit sales. Notice that the merchandise inventory account is not affected under the periodic system. It is not updated. Under the perpetual system, however, when we make a purchase of inventory, we debit merchandise inventory and credit accounts payable for the cost. And then later, if we sell it, we of course record the sale at the retail amount, but then we do a second entry to transfer the cost of the merchandise inventory that we just sold into cost of goods sold. So our merchandise inventory should be correct because we added it to inventory here and we took it out of inventory here when we sold it. So for the remainder of the chapter, we're going to follow the periodic method, not the perpetual, in determining cost of goods sold and ending inventory using different cost assumptions. So let's assume that a company has 50 bikes remaining at the end of the year, which means they've sold 200. So the company started with 40 bikes. They purchased 60 and then 80 and then 70 more. So they had a total of 250 available to sell. At the end of the year, they only had 50 left, and they've sold 200. So what was the cost of the items we sold? And how much is the cost of the items that we still have on hand? Well, that depends on the inventory method that we use. The first method that we will review is specific identification. This method is used when each unit of inventory can be specifically identified. Examples include car dealers, motorcycle dealerships, furniture, appliance sales, and fine jewelry. Specific identification is only practical for businesses in which sales volume is low and inventory unit value is high. So let's see how specific identification works with our bicycle example. Okay, so we have a list here of our beginning inventory and purchases, and we know that we still have 50 remaining in inventory and 200 that were sold. So your problem in the book will tell you specifically which items were sold and which ones you still have. So for example, if we're told that 30 of the beginning inventory units were sold, we know that we still have 10 of those. For the first purchase, 50 of these were sold, so we still have 10 in ending inventory. From the second purchase, 60 were sold, so we still have 20 in ending inventory. And from the third purchase, 60 were sold, so that means we still have 10. So we know exactly which 50 still remain and which 200 were sold. So if you remember from the previous example, we sold 30, which had a $62 unit price, 50 with a $65 unit price, 60 with a $67 unit price, and 60 with a $68 unit price. Those totals are listed here, added up, so we know our cost of goods sold total $13,210. Likewise, from the beginning inventory, we had 10 units left in ending inventory at $62. From the first purchase, we had 10 units of inventory at $65 a unit. From the second purchase, we had 20 units at $67 a unit. And from the third purchase, we had 10 at $68 a unit. When these are multiplied out and added up, we know our ending inventory cost is $32.90. So let's look at the next method. This method is called first in, first out. It assumes that the first goods purchased were the first goods sold. Whether or not that's actually the way the goods flowed, this is the way they're counted. So we have the most recently purchased goods left in ending inventory, and our oldest goods are the ones that are assumed sold. This follows the natural flow of goods for some businesses, like grocery stores, fruit stands, or computer software. So let's see how first in, first out works. Okay, so we know that we've sold 200. So if we've sold the first 200 under first in, first out, we've sold the 40 from beginning inventory, the 60 from the first purchase, 80 from the second purchase. So if we add all those up, so far we've accounted for 180. That means we've got 20 that we need to pick up from the third purchase. So this first 200 was sold. The last 50 from the third purchase are in ending inventory. So let's cost these out. For cost of goods sold, remember 40 units were from beginning inventory, 60 from the first purchase, 80 from the second, and 20 from the third. Okay, when we add all these totals up, we come up with a cost of goods sold of $13,100. As for ending inventory, remember our units came from the third purchase because under first in, first out, all the first 200 units are sold. So we're left with the last 50 at $68 a unit. So our total ending inventory is $3,400 under first in, first out. The next method we'll look at is weighted average. Weighted average computes an average cost per unit using the following formula. We take the total cost of the units available for sale and divide them by the units available for sale. So let's apply that to our example. Here is our total cost. If we add up the total cost of our beginning inventory and all our purchases, we come up with $16,500. If we total up all the units available for sale, we come up with 250. So these 250 units cost $16,500. 16,500 divided by the 250 units gives us an average cost of $66 a unit. So instead of costing each individual unit, we're going to apply an average cost. So our cost of goods sold is the 200 units that we sold at $66 a unit for a total cost of goods sold of $13,200. That means our ending inventory with 50 units at $66 a unit is $3,300. The next method is last in, first out. This is just the opposite of first in, first out. It assumes that the sales in the period were made from the most recently purchased goods, while the oldest goods remain in inventory. Okay, so the first 200 units are our newest units. So you start counting from the bottom. So that means we've sold all 70 of the third purchase, all 80 of the second purchase. We've accounted for 150. That means we need 50 more from the first purchase. Okay, so when we cost those out, we had none from beginning inventory. All those went to ending inventory. So none of those were sold under last in, first out. So our last 200 units had a cost of goods sold of $13,370. Okay, our ending inventory is from our oldest units. So we had 40 from beginning and 10 from the first purchase, which total up to $3,130.